oil sell-off today, it actually sort of started around 10:30, 11 a.m. New York time, which is when the market started to process the pretty significant downward revision to U.S. employment to March 2024. The price action was pretty interesting because that sell-off came on the back of a drop in U.S. crude inventories to a seven-month low. The view of our economists is that the market reaction to this benchmark revision for U.S. employment is exaggerated because, for technical reasons, we think that immigration is not elevated immigration is not sufficiently included in the revised employment numbers. And it's old news to some extent. We have evidence from the July data, from retail sales, or from August initial claims data that the U.S. economy is fine. While we do see the risks to oil, to our 75 to 90 Brent range to the downside, we're more focused on downside risk from China than on downside risk from the U.S. And the West more broadly, where demand is pretty resilient.
Downside risk from China, world's #1 economy, world's #1 consumer of oil. How much of this is pretty much to be expected? Because there is an energy transition going on there. You know, we've been talking about EVs for a long time now, how China's dominating that space, and how in China itself, more than one out of every 2 cars sold in China is now an EV, which, I mean, stands to reason. If that's the case, then they probably don't need as much oil.
No, that's right. We do think that a significant extent of the slowdown in Chinese oil demand growth is structural. Just to put things in perspective, in the first half of this year, Chinese oil demand grew on a year-over-year basis by just 200 kbd. That is 3 times lower than the 600 kbd average in the 2016 to 2019 period. And the year-over-year demand growth numbers actually turned negative in China, this number. If we break down this slowdown, it's really 2 key factors that explain the slowdown. Number 1, as you hinted at, fuel switching, with both ICE cars switching to power for EVs, but then also interestingly, trucks shifting to liquefied natural gas fuel. And then the second driver is petrochemical normalization. During the pandemic, Chinese demand for oil-based feedstocks to basically produce plastics surged, likely at the expense of demand in other regions. And with excess capacity in the petrochemical sector, that part of Chinese oil demand growth has slowed. And so, yes, some of the slowdown is to be expected with slower China GDP growth and a rapid rise in EVs. But I think some of the slowdown is unexpected, this switching to LNG away from diesel, and also this normalization in petchem demand is somewhat sharper than we and the market had expected.